So, how likely are you to lose money in the stock market? The answer might surprise you and could change how you invest forever. Let's uncover the truth about risk, reward, and the power of time when it comes to your money. Welcome back to Simply Money. Today, we're looking at the risk reward scenario in the stock market. There are a lot of people who are willing to take extreme risk, and that is very dangerous. But likewise, there are just as many people who are afraid to take any risk, and in doing so, their money doesn't work for them. They don't allow their money to keep up with inflation. Their money sits in a bank account, possibly making the same amount as inflation, but most likely less. Or maybe they take an extremely conservative stance or only get CDs or money markets, and the money isn't growing at a significant enough rate to keep up with the inflation that they're going to encounter over the lifetime of their investments. There are people who believe that if you go into the stock market, it's like gambling. And I want to talk to you about this, the difference between investing and trading. There are those who are involved in day trading or trying to buy something and hit it big and looking to sell it quickly to turn a quick profit. That's not what this channel's about. We're about investing, buying and holding for long term. And I want to show you statistically why this is the best way, the safe method, and how your return on investment will grow, and that risk is mitigated by time. First thing I want to show you is this chart here. When you look at this, you can see these different time frames. If you were to invest in the stock market, your odds of losing money. Now, this doesn't mean you're going to lose everything. Doesn't mean that if you put $100,000 in, you have a 30% chance of losing it all. It means you have a 30% chance of losing some money. The odds of in 6 months, if you were to put $100,000 in an investment today and then sell it in 6 months, the odds of you losing some money is 30%. Now, we're using the S&P 500 over time. Your odds would be drastically different if you were to pick just one stock. I use examples from the past. Back in the 80s, companies like Kmart, Kodak, Sears, these were some of the big hitters of the day. If you had invested all your money in those, your odds of losing money were significantly higher because those companies have gone out of business or drastically dropped their value because they were unable to keep up with the changing times. The same thing could happen with Nvidia or Apple or Microsoft. Will it? I don't know. I doubt it, but I'm not taking the chance and increasing my risk by putting everything in one basket. That's why the S&P 500 is a great, safe way to diversify your investment because you are investing in the 500 top companies in the United States. In the S&P 500, the top 500 companies based on capitalization, the most valuable like Apple, all the way down to the 500th smallest company. And there's smaller companies, but they take the top 500 and then they weight them depending upon their valuation. So new companies that are coming up and rising may take the place of some smaller companies who have fallen out. Likewise, a large company like Apple, if it begins to devalue, it will take up less weight, so it won't hold as high of a percentage. So your money is being rebalanced continually and automatically, and it takes out that. So that's why we're using the S&P 500 as an example. And what we'll be doing here is looking at these different time frames of the risk, but then we're also going to look at the different time frames in the reward. As you can see here, if you were to invest in the S&P 500, an index fund for 6 months, and then sell it, your odds of losing some money, it could vary from $1 to $100,000, but the likelihood of losing $100,000, of losing everything, is extremely low. Imagine the United States if the top 500 companies went belly up, bust in a 6-month time frame. Obviously, there is something extreme drastic. We have bigger things to worry about whether or not we lost our $100,000. I'm not going to worry about some extreme apocalyptic scenario because we're not here to talk about that. The odds are that 30% of the time you will lose some money. Most likely it's going to be anywhere between 1% to even 50% because there are downturns in the S&P 500 like COVID-19 where the market dropped drastically, even though it was only for a short period. Now, if you extend that to 1 year, that drops by 5%. Now your odds of losing some money is 25%. Again, not great odds. That's why you don't buy and sell for a year. If you're putting money that you need for a down payment on a house, if you're putting money into the market that you're going to need in the next year or two, I don't recommend it because the chances are 25% in 1 year that you could lose money. So you want to put it in somewhere safe like a CD or a money market or some high-yielding savings for short-term items, buying a car, new house, whatever the case may be, where you have money that you're going to need to touch in the next year or two. And that's why if you look at 2 years, it drops down to 20%. Again, not great odds that I want to put $100,000 or $1 million into the stock market and take a 20% chance that I might lose some of it. I'm not in it for 1 or 2 years. We're going to look at this now. 5 years, it drops down to 10%. Now, some people are willing to do that. They're willing to take those odds that, okay, in 5 years, I might be down 1 or 2 or 5% or whatever the case might be, but there's 90% chance that I could be up 10, 20, 30, 40%, depending how the market's done over that 5-year period. But some people, they start looking at the risk reward saying, hey, this is a little bit more doable. I can deal with that. Now we're looking at 10 years. It's only 5%. And that's what I tell people. If you're looking to invest, you're looking at 5 years and beyond. I really look at it at 10, 20, 30 years. If you're 30 years old, you're investing for your future when you're 50, 60 years old and what that money can do for you to be self-sufficient and take care of you in your older age. And that's where we get to the time value of investing. 20 and 30 years, there is 0% chance historically that you would lose any money. Meaning that if I put in $100,000 in 20 years, there's been a 0% chance over the history of the stock market that a 20-year period I would lose any money, not even a single dollar. This is just to show you the risk aspect. Time mitigates risk. Now let's look at a couple other charts here. This is comparing those same time frames. We still have in the red the risk, the odds of losing money based on time frames that you've invested. But I've also shown here the time frame, what is the average return. So as you can see, at 6 months, you're at the highest odds of losing money and you're at the lowest percentage of return. The average return of the S&P 500 over its lifetime in any 6-month period is a 2% return. So you're taking a 30% chance that you'll lose money to gain a 2% gain. Now, there are 6-month frames where you could gain 50%. But remember, there's also 6-month time frames where you could lose 50%. So the risk reward is at its greatest disparity right now. And as you can see, as we go down the line here to 1 year, we have 25% risk of losing money and 6% return on average. 2 years, it drops to 20%. You gain a little bit more on the reward. 5 years, you're down to your 10% odds of losing some money, but you're up to 8% average return. And then 10 years, you're at 5%. This is the first time where it crosses over where your odds of losing money is lower than the average return that you could get. But doesn't mean that 5%, you couldn't lose 20% of your money. The odds have gone down drastically, and the odds are that you would only lose a small amount in that 10-year time frame. But your odds are also much greater that you would average the 9% return over 10 years, 9% averaged yearly. And that's a great return. Then we go out to the 20-year and 30-year, and you see we're at the 0% odds of losing money based on historical data, but you're now at the historical average of the S&P 500, which is 10%. So if you're investing for 20, 30 years and beyond, your odds of losing money have basically diminished. So people say, oh, the stock market's too risky. Not if you have time on your side. If you're looking at long term. And this is where people retiring have to be careful because they may need to access some of their money within 6 months or 1 year. And this is why we recommend a bucket strategy where you have a couple years of expenses set aside in a non-volatile, high-yield savings, CDs, money market where you can access it in the 30%, 25%, or 20% chance that you're losing money during that time period, where you can wait it out before you start withdrawing money, where you get into these higher odds where you're beginning to see that money growing. So the bucket mitigates some of that risk when you're needing it. But for early investors who are not going to need it for 5, 10, 20 years, you want to look at these odds here where your odds of losing money have diminished and you're now hitting the 10% average. 1 year it might be 30% return, another year it's negative 15%, but it averages out over 20 years, 10% annually. And that's great returns, and that's a great way to outpace inflation. Let's go to another chart here. This is showing if you were to invest $10,000 lump sum, how it would grow based on those averages we just showed. The average return in 6 months was 2%. The average return in 1 year was, 5%? I'm sorry, 6%. So you're looking at these rates of return on average. This is what $10,000 would grow to over these different time frames. What I want to point out here is look at 10 years. $10,000 has a little more than doubled to $23,000. It took 10 years to double the 10,000. But look what happens over the next 10 years. Now you're up to $67,000. Not only did you 6 times, almost 7 times your initial investment, you have now almost 3 times your money from the 10 years prior. That's the power of compounding. And look at the next 10 years. See how compounding, imagine if you only on these 10 years gained another $23,000. You'd be at $46,000 here. And if that same thing happened here, you'd only be at $70,000. But that's how compounding works. And you see that time mitigates risk and it brings reward. The longer you have, the more powerful your return and investment becomes. So think about time as your best investment in your finances. The final chart I want to show you is comparing how adding a little bit each month can change the outcome. So you have in the blue here the initial investment that I just showed you of $10,000 over those time frames. At 30 years, you can see that we'll say $174,000 is what that would grow to. But if you added only $300 a month, you can see in 10 years, 20 years, and 30 years, the massive difference that $300 a month adds to the ability to grow and compound. $300 a month, you're going from $174,000 to $876,000 return. That is by making a consistent dollar cost averaging investment to the S&P 500. And if you made that $500, look at that, $1.3 million in 30 years. If you're 30 years old, when you're 60 years old, you have the power of compounding on your side, the power of time, and that mitigates risk. You're at a 0% chance odds of losing money, and you're at a great opportunity to grow money. Now, this is on average. It could be the next 30 years may be lower. Perhaps this is only $1 million. Are you going to cry about that? Probably not. But it could also be 1.5, 1.8 million if the next 30 years happens to be a little bit better. But again, just like the odds of losing money, historically, they show that 10% is the historical average. And the longer time frame you have, the more consistent that average becomes. You can get 10% in 1 year or 2 years, but the odds, consistency of that have gone down because time is what brings that consistency on both the reward and the mitigation of the risk. This is just a quick overview of how to overcome the fear that you may have of the risk of the stock market. Don't go for one stock. Don't put all your eggs in one basket. Get into low-cost index fund, diversify your investments, and let time be the most powerful thing. And don't be overly risk averse. Don't try to become rich quick and put all your money into these high-risk stocks, because those odds I just showed you are for the S&P 500, not for single stock picking or day trading or all this stuff you see. If you want to do that, that's your business, but this is the slow, steady way to become financially free and to build wealth. Thank you for joining me on Simply Money. Hit that like and subscribe button. Don't forget to leave a comment. What are your thoughts on this? Give me some input, and we'll see you next time on Simply Money.